But my opinion is that China and Russia have significantly more ounces of gold than the US does. And that I cannot back other than with other kind of reports I've read from contrarians who looked at these producers of gold, how they report their gold, how they store their gold, how their citizens own their gold. It's my opinion that if we revalue gold to 20,000, that would certainly, or 15,000, again, I'm speculating, no one knows. But if we did revalue gold higher, the adage, he who has the most gold wins, would apply. I think that would certainly help us in the near term with basically using gold as QE, because certainly by monetizing gold and repricing gold, that's better than just creating money out of thin air to pay down our debt like we do at the Fed. If we monetize and revalue gold to pay down our debt, it's 7 trillion or 5 trillion, depending on where we revalued it at, that would be a short-term boon for the US.
While headlines obsess over interest rates, inflation, and tech stocks, China may be executing a slow, stealthy plan to reshape the global monetary order, one gold bar at a time. Officially, China holds just over 2,000 tons of gold, but many analysts believe the true number could be 5 to 10 times higher. If China openly announced its full gold buying intentions, the price of gold would surge overnight, making future purchases dramatically more expensive. In Matthew Piepenburg's view, China and Russia would likely respond strategically to any U.S. revaluation, possibly setting even higher prices on their exchanges in Shanghai and St. Petersburg. International organizations, such as the International Monetary Fund and the Bank for International Settlements, would play crucial roles in facilitating or resisting changes to the monetary system. Their institutional perspectives typically favor gradual evolution rather than revolutionary changes to the global financial architecture. Seasoned expert Matthew Piepenburg warns that revaluing gold may be inevitable. He points to recent Fed reports from May and August that subtly hint at the possibility of marking U.S. gold reserves to market. At today's prices, that could instantly add roughly $1 trillion to the government's balance sheet. What if the Treasury revalued gold to $20,000 per ounce? That could shave $5 to $7 trillion off the national debt and set a permanent higher floor for gold prices, a dream for gold investors. At a critical juncture in America's financial history, the relationship between U.S. Treasury gold reserves and government debt has reached historically significant levels. Currently, gold reserves represent a mere 2% of total outstanding government debt, marking one of the lowest ratios in 90 years and highlighting a fundamental shift in America's financial foundation. Ultimately, Piepenburg notes that past U.S. gold revaluations happened virtually overnight. While he sees an above-spot revaluation as unlikely for now, he wouldn't rule out a sudden move. Before we dive into Matthew Piepenburg's sharp insights from his latest interview, make sure to hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the market. Let's get into it.
Look, I'm a gold bug. I'd love to see gold revalued at a higher price from the bid from the Treasury so the Fed can push gold up. But before we get to that type of fantasy, that type of clickbait of $20,000 gold by fiat, let's look at the reality of these reports. Let's look at the reality of the ramifications, and let's do our best guessing for each of us to determine on our own. I've been thinking about revaluation for years. That was tinfoil hatted in 2020. Francis Hunt was talking about this years ago too. That was tinfoil hatted. To your point, now it's becoming mainstream. Not surprising, it's becoming mainstream because the debt levels have gotten so exponentially worse. And as far as in the issue, I said at the very beginning, to me, revaluation, just like a gold-backed U.S. Treasury, is a sign of, you could say, sounder money, but it's also a sound of desperation. It's a confession that we're in debt. It's a confession that our dollar is distrusted and less valuable. It's a confession that gold is a far more centralized, in central and I think critical asset today than it was treated 10 years ago. So these are all very important for the gold camp. But in terms of the reality of a gold revaluation, this report in August, which I just did a Substack discussion on today, and the one that came out in May, this was a May Fed manual. They're both kind of, you could say, telegraphing in a psyop way or planting the seeds of a possible gold revaluation. And let's think about that. Would it work? These are the reasons. When you read this report, it's very sanguine. Ultimately, the mood is it's a temporary fix only, and we're really not in favor of it. It kind of takes away central bank autonomy. But by the way, Lebanon did it, Curacao did it, Germany did it, Italy did it, etc. South Africa did. These are 5 examples from 1997 to 2024 where countries have revalued their gold reserves to get out of a debt problem. And the question then would be, okay, it's been done. That's them kind of suggesting we're not the only ones going this way. Although I wouldn't, comparing the US to Curacao, St. Martin is kind of sad, or Lebanon is kind of sad. There's a whole other rabbit hole there. But that's how desperate we are. I've said many times we have the balance sheet of a banana republic. But okay, we've got $42.22 certificates. We've got 261 ounces. Some say 287,000, million ounces. If we revalue at the current spot price, that gives us, just shy of 900 billion. Let's say, for simple good math, obviously, let's say it gives us $1 trillion at the mark-to-market price, which legally on the balance sheet of the Fed and the Treasury, the asset and liability side, that May report says this can be done. So it can be done. And Dissent has said we need to monetize some of our assets and the balance sheet of the Fed. This would obviously be gold. So if we marked gold to market, which is what a Forbes article in February this year said, well, that's $1 trillion. So that helps us a little bit with our debt to GDP. But so again, my point was going to be that's a guppy solution to a whale of a problem. Even Doge, as laudable as it was, despite the problems with Elon Musk and Trump, even if Doge succeeded at its policies, that was still a guppy solution to a whale of a problem. Again, better than nothing. So to your point, what's $1 trillion in this backdrop? And so there's speculation that we could put in a bid for $20,000 gold, $15,000 gold, $10,000 gold, even at 20,000 gold. If you're getting 5 to 7 trillion, that's a significant dent in the debt to GDP. If we went from 37 to 30 trillion by revaluating gold from an act of fiat at the Treasury and the White House, that would definitely get our debt to GDP at a place where you could argue growth is possible. And you could argue that makes sense. That's not desperate. That's common sense. Let's take those $42 certificates and give them something bigger than market. But then you're creating an entirely new floor for the gold price, which for gold bugs like us would be fantastic. I certainly wouldn't. I should be selling that book all day long. But realistically, you've got to go back to Kissinger's warning about revaluing gold, because this is my opinion. It's only my opinion. It's in the face of the World Gold Council. But my opinion is that China and Russia have significantly more ounces of gold than the US does. And that I cannot back other than with other kind of reports I've read from contrarians who looked at these producers of gold, how they report their gold, how they store their gold, how their citizens own their gold. It's my opinion that if we revalue gold to 20,000, that would certainly, or 15,000, again, I'm speculating, no one knows. But if we did revalue gold higher, the adage, he who has the most gold wins, would apply. I think that would certainly help us in the near term with basically using gold as QE, because certainly by monetizing gold and repricing gold, that's better than just creating money out of thin air to pay down our debt like we do at the Fed. If we monetize and revalue gold to pay down our debt, it's 7 trillion or 5 trillion, depending on where we revalued it at, that would be a short-term boon for the US, for sure. That would bring our debt down significantly. But then in terms of our global leverage, and this is what Kissinger warned about many years ago, well, then what is China and Russia with their own exchanges in St. Petersburg and Shanghai? You think they're going to float a gold price at spot today? If we go to 20 or 15,000, they're going to price it more fairly, and they're going to have, I think, more ounces of us and therefore more leverage with their currency and with their trade than us. That's my view. Again, take it or leave it. Some would disagree. But I think the tone right now of these May reports and August reports is it's still, to me, a long shot that they would revalue higher than spot. But on the flip side of that, let's not forget 1930s America under FDR. Overnight, you can make gold confiscatable and then reprice it for the government's benefit. And that happened overnight. Let's not forget 1971, literally 54 years ago this month, when Nixon just got on the phone and said, this is a temporary measure. We're going to decouple from gold. It's going to be very temporary, and your dollar will be worth just as much tomorrow as today. Again, we know that the dollar's lost 98, 99% of its value against gold since that famous lie. But is America under Trump, is this the Nixon America or the FDR America? Can we just suddenly wake up one afternoon and see this announcement that gold's been revalued? Sure, it's possible. Is it likely? Who am I to say? I would certainly love to see gold revalued as a gold owner. But right now, based on the tone of these reports and the message, it's very hard to determine.
Veteran investor Matthew Piepenburg underscores that the gold space is currently flooded with hype and clickbait. He points out we're living through the worst geopolitical tensions since the Cold War, from tariffs to weaponizing the dollar, and even Fed talk of gold revaluation. He sees these as desperate measures. For him, gold is the ultimate truth detector of a failing system. Since his return to the presidency in 2025, Donald Trump has adopted an aggressive stance toward BRICS, particularly targeting their de-dollarization efforts. On January 30th, 2025, Trump posted on social media, warning that any country pursuing de-dollarization or a BRICS currency would face 100% tariffs and exclusion from U.S. markets. However, investors have been riding the gold gravy train all year, according to the latest gold demand trends report from the World Gold Council. In his outlook, Piepenburg states that gold has shifted from a fringe asset to a central pillar of global monetary debates. He links this to the 2022 weaponization of the dollar, which eroded trust and boosted central bank gold buying. A U.S. gold revaluation is now a real possibility, whether to market value or a higher permanent floor. Let's get back to the interview.
Listen, I mean, there's easy criticism in the gold space. It's a lot of sensationalism, a lot of clickbait, a lot of permanent negativity. And I understand that. And I want to get to the point where we're looking at facts and drawing our own opinions and not just data mining, but data analyzing. I think before we get into very important examples of what I consider desperate reactions, not necessarily effective reactions, you need to put it in the perspective of the world we're all participants in current events, whether they're market events, currency events, geopolitical or military events. Sometimes it helps to put those current events into past perspectives as well. But I think what I'm seeing right now is a watershed moment, a kind of convergence of anxiety and desperation, and yet some paradoxical hope that the S&P and the White House will save us. And I want to look at that objectively as possible without just being negative. But I think in the larger perspective, we're seeing the worst global relations since 1949, probably the greatest financial bubble in the history of capital markets. I would think the highest geopolitical, military, and nuclear risk since the Cuban Missile Crisis, and probably the lowest trust in Western governance. Again, from the G7 to Jerusalem, from DC to Kiev, there's a distrust in leadership that's pretty palpable. We also, of course, have the greatest debt levels in the history of mankind. And as David Hume said in the 1750s, or von Mises centuries later said, debt destroys nations, it destroys peace, it destroys freedoms. And Ernest Hemingway said in the 1940s that when you see debt-soaked nations, you then see the permanent ruin of currency debasement and war. These are certainly important things to consider right now. And I think also the jig is up on paper money, the inherent purchasing power of fiat money. I think electronic money, including stablecoins, which you introduced, which we'll get into more detail, is just another example of that fantasy empirically. And I don't think it's any different. So the world is moving to gold, I think, which we'll obviously get into as well, as kind of a BS detector on these broken things. But I think in this backdrop of so much dysfunction, financial, political, currency, and debt, there's a lot of desperate policies kind of masquerading as evolutions, as energy, as kind of audacity. And it's certainly good to see energy compared to the last administration. And these policies under Biden or certain policies under Trump, to me, weaponizing the world reserve currency, the whole stablecoin CBDC meme, the tariff policies, the External Revenue Service, even the BTF plan during the banking crisis under Biden, this fantasy that the Fed can control rates and money supply like a thermostat, to keep the economy in order. The dysfunctions we're seeing in the comics and the stories we're being told about that, the idea that we should blame the BRICS for our own overspending in the U.S., even the conversation, of course, from Judy Shelton on gold-backed U.S. Treasuries, and now from the Fed and the Treasury on gold revaluation. To me, these are desperate, not exciting signs, and I'll give reasons why. I think in this backdrop, I go back to history too to put it into context. I mean, we have to, comfort our own assessments. You don't have to take my assessment or Willem Middelkoop's assessment or Luke Groman's assessment or Donald Trump's assessment or Egon von Greyer's assessment. But I think, as John Kennedy said, there is something immoral about abandoning your own judgment. And to trust your own judgment, it has to be informed. Again, it doesn't have to be, overlap with mine, but informed judgment gives us some, I think, peace. And I think informed judgment is very hard, though, because it means you have to dig into some rabbit holes, some math, not hard math, and you have to look critically at even your own convictions and biases. And it's very hard in geopolitics and certainly in national politics to have an informed opinion with so much noise. But certainly in economics, it can be very hard to have an informed opinion. John Kenneth Galbraith, who was Kennedy's economic advisor, said that economics really aren't there to reveal truth, but to actually kind of disguise and evade truth. That was his final lesson from economics. And it reminds me of the complexity scheme or scam that I see in the markets from when I was a young idiot in the dot-com bubble to something a little bit more educated in markets through being a veteran. But there is so much intentional complexity, complex plumbing in the markets, whether it's central bank policy, whether it's derivatives and swaps and asset-backed security tranches and rating agencies, whether it's the COMEX and the FX exchanges, or certainly now as we get into the stablecoin or Genius Act oxymoron, there is intentional complexity. So it's very hard for the average man or woman on the street to really make an informed opinion on that. And I think that's, incumbent upon us. And I'll say that great economists, honest economists, whether it was Lord Mervyn King, who's still in the UK today, said economists are always looking to optimize. They're never looking at reality, that everything's optimizable. And as Richard Werner has made very clear in the last few years, these stochastic models that the Fed uses and the economists use to get tenure or to get popularity in the academic or think tank circles, none of their models have brought inflation to 2% in any of the developing economies over the last centuries. So it's breaking away from consensus think to contrarian think without just being nihilistic thinking. I think it's up to each of us. Again, it doesn't mean just taking my views. And I think the real goal for us and for every conversation is to set out the facts as we know them, draw our own conclusions. I will certainly have mine. But I think gold is calling BS on all of these systems, all of these solutions, all of these models, all of these optimization nonsense, this be calm, carry on, as we're looking at the menu on the Titanic. And again, I've said many times, deciding between duck, fish, or steak, or red or white wine, when we really should be on the deck looking at the iceberg. And no one wants to see that because it's painful and it's unattractive.
The US, China, and Russia now sit at the center of this monetary chessboard. The global gold market is experiencing a profound transformation that could lead to a significant price revaluation. Based on historical precedents from 1972 and 2005, the time frame suggests possible continuation of consolidation into August before the next trending move emerges. This projection is based on the observation that major consolidations in gold bull markets typically last 4.5 to 5 months, with the current consolidation approximately 3 months old. If the US revalues first, will China and Russia use their hidden gold reserves to outmaneuver Washington? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.